Warriors of price action and guardians of fundamentals. Welcome to Retail Recon. On today's mission, we're debriefing the bear put spread, also known as the long vertical put spread or debit put spread. This is one of the most popular defined risk directional strategies you can run when you expect a stock to drop or move lower over a defined period. It lets you capture downside movement and gives you a predefined maximum loss from the start. In this episode, you'll learn what the bear put spread is, how it behaves in different market conditions, when to run it, and the key traps to avoid. So gear up and let's go to work. Think of a bear put spread as a two-tiered setup. As with all vertical spreads, one option is the main driver while the other acts as a safety buffer. That is, in contrast to buying or selling single options, vertical spreads, that is, combining two options of the same type and same expiration, add a layer of built-in protection that single options lack. A common phrase you'll hear in this regard is adding a wing to your trade. But there is also a trade-off. Your profit is capped as well. With a bear put spread, you're directionally bearish or mildly bearish. You expect the stock to fall or stay below a certain level. To express that thesis, you're using two puts, but contrary to the bull put spread we debriefed in the previous episode, your higher strike is above the current price. You're buying the higher strike and selling the lower strike. To make the structure absolutely clear, you buy a put at the higher strike, the long put, which in most cases will be in the money or at the money. This is your main engine for capturing downside. The closer this strike is to the stock price, the more sensitive it is to a drop. It is also the most expensive part of the trade. You sell a put at a lower strike, usually out of the money, the short put. This is your risk offsetting layer. You sell it to reduce the cost of the long put and cap your maximum loss. It also limits your maximum profit once the stock falls below this strike. In most cases, you pay a net debit to enter the trade, but you're reducing your cost basis with the lower strike and you're also defining your maximum loss. Key point here, you're not just buying a naked put with a simple directional bet. You're buying a spread, so you have predefined risk limited to the net debit paid in case the trade turns against you. Let's break down the core elements through a concrete example. On screen, you have a daily chart of Nvidia. Suppose you have a short-term bearish outlook and you think Nvidia will drop down or stay flat in the next couple of weeks. First, you determine your levels based on the chart. Your thesis is Nvidia will not break above 240 in the next 4 weeks and you're comfortable with the distance from the current price. On screen, you have the Nvidia puts option chain for the June 18th expiration date. Since Nvidia is highly liquid, you can see bids and asks are tight. That's exactly the kind of environment you want to see. Let's say you decide on the strikes 240 and 250. From what you know by now, which strike will be long and which will be short? 250 is the long leg, higher strike, further away from the current price. 240 is the short leg, closer to the current price. Now let's assume the long put is bought for $33.50 and the short put is sold for $25.20. Net debit $33.50 minus $25.20, 8.30. That means this spread will cost you $830 per contract. The net debit paid to enter the spread is also your maximum loss, if the stock stays above the higher strike at expiration. Now calculate the max profit. Width between the strikes, 250 minus 240 equals 10, minus net debit, 10 minus 830, 1.7. Max profit per contract in this case is $170. You will achieve max profit if the stock is below the lower strike, 240, at expiration. As always, I like to check the risk-reward ratio. 170 divided by 830 equals 0.2 or roughly 1 to 5 risk-reward. And finally, calculate the break-even. Break-even equals higher strike minus net debit paid, 250 minus 830, 241.70. As long as the stock is below 241.70 at expiration, you're profitable. Now that you crunch the numbers, would you take the trade? There is no right or wrong answer here. Every trader operates with a different set of rules. Based on my book, I would take a pass on this trade. Now let's look at different scenarios at expiration to drive the point home. Stock stays above the higher strike, 250. Both puts expire worthless, you lose the net debit you paid, that's your maximum loss. Stock is below the higher strike but above the lower strike, between 240 and 250. Your long put is in the money, so you're gaining value. The short put is still out of the money, so the expiry is worthless and you keep the premium. Your profit grows as the stock moves lower, but you haven't hit your max yet because the price is still above your short put. Stock is below the lower strike, 240. Both puts are in the money, but the short put you sold caps your upside. The short put starts gaining value for the buyer, which means it increases your loss. Your profit peaks at the width of the spread minus the net debit. Below that point, your long put gains are capped by the losses on the short put, so your profit doesn't increase anymore. When the strategy fits, a bear put spread is best used when you're bearish or mildly bearish on a stock, you expect the stock to fall or stay below a certain level over a defined period, you want defined risk downside exposure, not unlimited risk from a naked put, and you're okay with paying a net debit to enter the trade. Typical battlefield conditions: stock that have run up hard and are now showing signs of weakness. Names facing earnings, guidance cuts, or macro headwinds. Situations where you want to cap your risk if the move is bigger than expected or if you're wrong entirely. I usually use relatively narrow spreads, around 5 points with meaningful distance between the strikes and the current price, so your risk reward and break even stay in a manageable zone. How to manage it? A bear put spread is defined risk by design, but it's also directional. You're paying for the drop and you're exposed to time decay as well. In practice, this usually means let it run if the stock is moving in your direction and you're comfortable with the time frame. Close early for a profit if the move happens fast and you're already captured most of the spread value. Cut early for a loss only if the thesis breaks, you see a higher probability setup elsewhere, and your marginal edge for exiting is better than holding. Do not treat bear put spreads like long calls and let it ride to expiration just because you're paying for time. If the move is slow, time decay will eat at your position. A word about deltas. Prefer moderate delta strikes, 0.3 to 0.5 for the long put if you're confident in the move. Use low delta strike, 0.2 or below, for the short put to keep it far out of the money and reduce early assignment risk. Don't obsess over the exact numbers, but use it as a sanity check against your thesis. Let's recap this mission. A bear put spread is a long vertical put. Buy a put at the higher strike, sell a put at the lower strike, same expiration, pay a net debit with defined maximum loss. It's a bearish weapon, ideal when you expect the stock to fall or stay below a certain level. Max loss equals the net debit paid. Max profit is the width of the strike minus the net debit. Break even is your higher strike minus net debit paid. Best used in bearish or weak environments with elevated IV when you want defined risk downside exposure without buying a naked put. And with that, we close today's briefing. If you found value in this mission, lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, stay on target.